Thank you for tuning into the All Funds Investment Podcast. Today's episode features Kevin Cott. Kevin is a partner at Cott Law Group, a boutique law firm focused on providing full-service legal counsel to the investment management industry. In this episode, we discuss the concept of closed-ended funds, differences compared to open-ended funds, and some challenges, nuances, and best practices. Just a reminder here that nothing said is legal, tax, or investment advice. Check out the full disclaimer below. We hope you enjoy this conversation. Please like and subscribe if you find this information helpful. If you'd like to be on the show, drop us an email, info@altfunds.io, or you can fill out the form below. Always looking for great new guests in the space. Lastly, check out the links in the description to connect with us and Kevin. Talk to us about closed-ended structures. What is a closed-ended structure? And what are, maybe some differences between a closed-ended structure compared to an open-ended fund structure?
Yeah, so it's a great topic because it's probably one of the most common questions we get, especially from less experienced fund managers that will sometimes conflate the two. And so, the way I like to think about it in like the most simple terms is it really just comes down to the underlying assets. So if you have, freely transferable assets in the fund that are easily marked to market, like public securities, commodity futures, liquid crypto tokens, you're going to want an open-end fund, which what that means is that you can allow investors in and allow investors out on an ongoing basis, really in perpetuity, until the GP decides to close the fund. In contrast, if you have relatively or underlying assets that are illiquid, that are not easily transferable and marked to market, it lends itself to what's called a closed-end fund, where instead of it being evergreen and you can kind of manage it in perpetuity, you bring in capital up front, usually through a commitment, and then you can draw down that capital over a set period of time. But the key is that it's got this fixed term, and eventually, the fund will kind of close based on how it's laid out at the outset versus operating indefinitely.
That makes a lot of sense, Kevin.
Yeah.
I think I'm just curious too, from your point of view, what you've seen as of late with that structure. And you mentioned digital assets. I know initially many managers are putting both illiquid and liquid assets in the same bucket, if you will. And that's really going to change. It seems like now there's a separation, which is helpful both operationally and just kind of make things cleaner going forward. Everything was side pocketed in certain cases, which can be a nightmare for operations, right? So I'm just curious, what are you seeing from your latest, setups on the fund side?
So that's exactly it. What you would see, originally was a lot of, let's say crypto funds that wanted exposure to liquid crypto, but also, some of these more illiquid assets, and they would try to put them, and some still do, in a single fund, in side pocket the illiquid holdings. But it gets messy. And so I do think you're seeing more of a divergence where you've got kind of liquid crypto funds and then, blockchain venture funds, sort of what you see with, traditional hedge funds and venture capital funds. And it makes sense. Like the way I try to think of it is it's almost like building a house. You've got everything is going to flow from sort of the way the land allows you to build it. So if you've got, a backyard that slopes down, you're not going to have a walkout backyard, but you'll have, a daylight basement. Whereas if it's fairly flat, you'll, maybe have a walkout backyard, but not a daylight basement. Same thing with a fund, right? Everything flows down, where if you've got these liquid assets, then you really need to have a closed-end fund because otherwise the mechanics don't really work properly. If you have a more liquid underlying strategy, then you want an open-end fund because a closed-end fund doesn't really add any value. I don't know if that analogy works because I'm not a builder, but hopefully it makes sense. But it's the way I like to think about it.
Absolutely. Yeah. We'll hire you to build our houses next time. We'll
sure.
Go through the process.
That'll go very poorly.
No, it's all good. No, it makes a lot of sense. No, I think it's helpful to understand just kind of with the underlying asset in the portfolio, liquid versus illiquid, it makes things cleaner and more efficient, both from your point of view and legally, from a setup point of view, as well as, ongoing operational work, that's definitely helpful.
Yeah. It's like, the architecture, the mechanics, they all kind of come from the same thing. And then everything really flows from that. And then we can kind of get into, the other differences between the two funds, if that would be helpful.
Yeah, that'd be great.
So, same thing. It's like everything kind of flows from this initial setup, and then as a result, it all falls into place. So there's a million areas where it's different, just like starting with the fees, right? So for an open-end fund, you typically have a management fee in a performance allocation, the management fee is just a percentage of the NAV of the fund. With a closed-end fund, it's a little bit different just because of the underlying assets. So there's a few different ways you can do it, but a lot of times what you'll see is the management fee will be charged on the capital commitment initially, like maybe through the investment period. And then at some point, it flips a switch where you start returning assets to investors, and then it's usually on unreturned capital contributions. And so the management fee will kind of go down in value over the life of the fund as the assets dwindle. It's a little more complex than what you see with an open-end fund, but again, it's based on the underlying assets and what kind of like naturally fits. Same thing with the performance allocation. With an open-end fund, it's usually monthly or quarterly or annually. Actually, that I should say quarterly or annually. Management fees usually monthly or quarterly, but it's just the same percentage of net profits each period, and it's subject to a high water mark, and it goes on indefinitely. With a closed-end fund, it's usually a different form. It's called a carried interest, or instead of having a high water mark, you have this more complex waterfall structure where as assets get returned to investors, they get a return of their capital contributions. They typically get some kind of preferred return. The GP gets what's called a catch up to kind of make them whole on that pref. And then you have the economics that you see with the hedge fund of like, an 80-20 split. And then, if sometimes there will be a clawback, which is kind of like the rough equivalent, but it's a more complicated structure than you see with an open-end fund.
That makes sense. I'm just curious, what with kind of where we're at today in 2023, what types of asset classes are in vogue that you've seen as far as launches between closed end versus open end? I'm just curious.
Yeah, it's probably anecdotal, but we're seeing a lot more closed end than maybe we had before. I think there's still a lot of issues with fundraising, so that's kind of the backdrop to all of this. But as that picks up, we've been seeing still some venture capital funds, real estate kind of opportunistic funds. We are still seeing some traditional hedge funds. We are still seeing some crypto funds. It's been a more balanced split than maybe what we were seeing in 2021 and 2022 when there was a lot of digital assets, funds in particular. This actually kind of feels like a healthier balance.
What are some things that fund managers should be considering when they're looking at structuring a closed-ended fund?
There's a lot. I mean, the other big piece that we haven't really talked about is the term. The challenge with all these illiquid type funds is you don't really know how long you're going to hold the underlying assets, but you're not going to hold them indefinitely, and fund investors need to come in and know that they're going to have some kind of exit date. So you set the term out up front, usually with some flexibility built in. So for example, a real common one is, let's say, a 10-year term with a 1 to 2 year option to extend as you liquidate the underlying assets. If there's still some underlying assets that can't be liquidated because of the market, there's means to kind of address that. But that's a big one, is kind of understanding what the total time period will be for the fund and communicating that to investors up front. The other one is how you're going to deploy the capital. Usually there's an investment period. Let's say it's like 5 years from the final close date where you can deploy capital and redeploy capital. But then you need to have some plan in place to eventually exit the fund. And so that's a big one that needs to be put in at the outset. There's usually more constraints on the strategy than you see with an open-end fund. And a lot of times you'll have more sophisticated LPs that will negotiate specific terms. Maybe the GP has to put in a certain commitment itself. In my experience, these tend to be, generalizing a bit, but they tend to be a little bit more complex and subject to more investor negotiation than you see with a lot of traditional open-end hedge funds.
Yeah, it makes sense. And I guess, this probably pertains to both sides, closed end and open end, but just maybe talk about what makes sense from, the managers, where their location is, where you set up the fund versus the investor, right? Those things do matter as you're setting up the fund, what domicile, what state, if it's US based, things that come up as they're setting everything up there.
Yeah, definitely. And that's usually universal across the fund type, right? So if you've got, in its simplest form, if you've got, US manager, US investors, the typical structure is you set up Delaware entities for everything, and then would register sometimes the fund itself, depending on which state you're in, but usually you just note you foreign qualify the fund manager in the state where the fund manager is based. And then, that's just a US offering. That's kind of the simplest approach. if you start taking in money from non-U.S. investors and or tax-exempt U.S. investors, if you use any leverage, both subsets of investors will typically prefer an offshore vehicle. So that's where you see, a Cayman or a BVI feeder fund, so that they can either, avoid having to receive a K1 or being subject to UBTI. That entity is a corporate structure that then comes into the U.S. fund most often in what's called a mini master structure. And then if you have non-U.S. fund manager and non-U.S. investors, it doesn't touch the U.S. It's usually just all offshore.
Yeah, one thing I want to come back to, you mentioned about typically there's a timeline for closing the fund. Maybe it's 7 years, 10 years. But during times of stress, like right now, as you can see, like you mentioned, a lot of funds are having difficulties raising capital, and that kind of flows downhill. A lot of companies are having issues raising capital. What happens with the time? The market doesn't allow for liquidity. Where if somebody has a VC fund, they have some of these earlier stage projects, but now they are kind of trapped, for lack of a better word. Maybe the market doesn't value them the same way.
Yeah.
How does the timeline change, and how does that affect the fund?
So there's usually, some kind of catch-all provision that allows the manager to spin off these assets that they can't liquidate as long as they need. I mean, there's really not much you can do if you're not able to sell it. You could get it gets kind of messy depending on the underlying asset, like whether you could do an in-kind distribution. But typically what happens is the LPs are redeemed with in proportion to everything else, but then that remaining asset, they'll have some interest in it until there's a final liquidation event.
Going off that topic of capital raising, it's been challenging, of course, as Mike mentioned, at times of stress where we're at today. I'm just curious what you say. Were you saying based on the setup of 506B versus 506C, right? General solicitation. Most people go that route, or they, what's the backdrop? What's kind of the main motivation? Obviously,
Yeah,
being able to solicit, it's a good thing, but then you have to verify each investor. So I'm just curious what you're saying as of late.
yeah. So it's a good question. So for a long time, the only real option was it was just Rule 506, where you could raise capital in theory up to 35 non-accredited investors, but really it should be all accredited investors, and you were prohibited from using any means of general solicitation or advertising. So it was all word of mouth, your existing network. You wouldn't send like an email blast to people you don't know or have like a public website for the fund, because that would be in violation of the rule. Several years back, the SEC basically bifurcated it, where you have what's called Rule 506B and then Rule 506C. B is kind of the old form version of the rule. C does allow you to generally solicit and advertise interest in the fund and market it. The catch is that you have to verify that each investor is accredited, which with the 506B, what happens is they fill out their subscription document, they check that they're accredited, they make a representation unless you have reason to know that they're being dishonest. That's really the end of your obligation. With a 506C offering, your obligation goes further. You have to actually verify it. So they can either submit their tax return or their brokerage statement. Usually the easiest means is just like a certified letter from their attorney or their CPA that they're accredited. So it's not actually as, I think, invasive or as difficult as some managers might think. So I do think like a 506C, if you're going to toe the line at all, is probably the way to go, because it's a pretty simple addition to put in your subdoc. That said, I still think the vast majority of funds we see are 506B that just are going to kind of stick to the old rules. They're not going to mess with that, and they keep it simple. But we see both.
Right.
Anything else people should be thinking about when it comes to closed-ended funds in general?
I'd probably just go back to that original point where a lot of times you do see, especially with less experienced fund managers, they kind of want to put a round peg in a square hole. I'm sure you get this a lot of times, like the fund admin side, and all service providers will kind of get these questions where they want to have the ability to do everything, but it ends up just making the fund so messy, because it again kind of go back to that maybe not great home builder analogy. If you kind of go against the land, you're just going to have all these problems flow downhill. So if you try to have an open-end fund with a liquid investments and everything side pocketed, you have to think about how that plays out. you suddenly, like, the administration and the auditing is infinitely more difficult. It's much more confusing for investors. Ones that come in later can't participate in the earlier investors. Ones that do come in to the, if most of the fund is in side pocketed investments, then they're just illiquid and sort of indefinitely anyway. So really, I think the best thing most managers can do is make a choice up front, usually based on the underlying assets, and kind of, these typical structures are there for a reason. So I think, with some exceptions, keeping true to that is usually the best approach.
Makes a lot of sense. Skylar, on the fund admin side, are you guys still, I know back in like 2020, 2021, there was a lot of these kind of mixed funds with, especially in the crypto side with a lot of crazy side packets. Are you guys still seeing a lot of that today?
No, not as much. To Kevin's point, I do agree. I think that that's becoming cleaner. People are separating the illiquid investments from the liquid, right? Which is key, which is important. So it's not as much of a crazy situation as it was probably a couple of years ago. We had tons of side pockets. Now they do come up, right? And there are always exceptions to the rule, of course. But I think for what we're saying, this, definitely get your thoughts, Kevin. Is the questions always gets asked. Well, what's the marketable approach for fee structures? Based on this strategy, what do you guys see? Those types of things, and obviously the big one, which is that the moving target of the new private funds rules and how they're going to affect clients going forward. And I'm curious, Kevin, how you're kind of advising your clients as you're setting up new structures now.
Yeah.
What to look out for, what to pay attention to. Just curious.
Yeah, definitely. And I will note, I mean, I don't want to overstate it. There's certainly plenty of funds that are, relatively liquid funds that do want to make one-off illiquid investments, and that's what a side pocket is for.
Right.
It's when you have a predominantly illiquid investment, but you're trying to structure as an open-end fund, that I think you run into problems. As far as the private fund advisors rule, yeah, we're getting a lot of questions about that. I have a few thoughts on it. One is there's still a lot of runway. It's not going to take effect. I think it was 18 months from the date that it was published. So fund managers do have a long time to plan for it. From my standpoint, there's a lot of talk about the reporting requirements. I think the biggest issue is the preferential treatment rules, and sort of the fact that you have this sea change where in the past you would disclose the ability to enter into side letter agreements, and maybe certain investors would negotiate a most favored nations clause, but overall you didn't have to disclose the terms of those side letters to your other investors, and that was just accepted. Now that's going to change. Everything has to be disclosed, and I think for fund managers that's a big shift. And then there's certain things that are outright prohibited, as far as like preferential redemption and information rights. I think there's a reasonable basis for most of it, but it's still going to take a lot of adjustment for fund managers. And so I think the thing that we're advising our clients to kind of be mindful of now is taking more of a thoughtful approach when you enter into side letters, because eventually that's going to be something that needs to be disclosed and it can affect how you operate the fund in the future, and once these rules do come into effect.
Yeah, great insight there. Absolutely.
Kevin, this has been great. Thanks so much for your insights on closed-ended funds. Where can people go to connect with you and learn more about Cott Law?
Yep. So you can find us at cottlawgroup.com. My bio and everything about our firm is on that website. We're also on Twitter and on LinkedIn. And feel free to shoot me an email at kevin@cottlawgroup.com, and would love to connect.
Awesome. Appreciate the time, Kevin.
Thanks, guys.
I hope you enjoyed this conversation. Please make sure to like and subscribe for more content like this, and reach out if you're interested in starting a fund, whether it's a hedge fund, VC fund, whatever fund you're thinking. We can help you out, and let us know if there's any other topics that you'd like for us to cover. Thanks for watching.
Guys.